Here's the thing, most people sitting on a part pension never check. A single bank balance update, one you didn't even think to report, can quietly cut your fortnightly payment by hundreds of dollars. Not because you did anything wrong, just because Centrelink's assets test doesn't care whether the money feels like spending money or savings. It counts it all. Hey, I'm Paul. Good to have you here. Over the next few minutes, we're going to walk through 4 types of accounts that are catching age pension recipients off guard right now, including some that most people genuinely don't think of as reportable assets. Let's start with the one sitting right in front of you, your everyday bank account, the one your super goes into, your pension payment lands in, where you pay the electricity bill from, that account. Most people I talk to assume it barely registers with Centrelink. It's just day-to-day money, they say. It goes in, it goes out. Surely that doesn't really count. It counts. Every dollar sitting in that account on the date Centrelink assesses you is counted as an asset, not your average balance across the month, not what's left after the bills clear, the balance as it stands. And here's where it quietly bites people. If your super pension payment or a lump sum withdrawal landed in that account the week before your review, that balance could look a lot healthier than it normally does. Centrelink sees a spike, your assets test position changes, your pension payment drops. Let's make that real. Say you normally sit comfortably under the assets test threshold, but last month you received a $10,000 insurance payout and it's been sitting in your everyday account while you figure out what to do with it. Under the current assets test, for a single homeowner, every $1,000 of assets above the lower threshold reduces your fortnightly pension by around 3. That $10,000 sitting there could be quietly costing you $30 a fortnight, or roughly $780 a year. The payout was legitimate. The account is normal. But the timing matters more than people realise. Now debunk the myth while we're here. Some people believe that if an account is small, or if they use it constantly, Centrelink somehow won't notice it, or won't count it as seriously. That's not how it works. Centrelink has data matching arrangements with Australian financial institutions. Everyday accounts, savings accounts, offset accounts, they all appear. There is no such thing as an account that's too ordinary to matter. So here's your action for this one. Log into your internet banking right now and look at your current balance, not last week's, today's. Then compare it honestly against what you last reported to Centrelink. If it's moved by more than a small amount, you may have an obligation to update them. Check your reporting requirements, and if you're unsure, speak with Centrelink directly or a licensed financial advisor before your next review date. Right? So you've looked at your own account. Good. But here's where it gets a bit trickier, and honestly, this is the one that surprises people the most. Joint accounts. The one you share with your partner, or maybe an adult child you set up a joint account with years ago to help them out. A lot of people assume that because it's shared, Centrelink only counts their half. Or they assume that because their partner manages it, it's really the partner's money. Neither of those assumptions is safe. Here's how Centrelink actually treats a joint account. The default position is that the full balance is split 50-50 between account holders. So if you and your partner have $80,000 sitting in a joint account, Centrelink counts $40,000 as yours and $40,000 as your partner's. That part, most couples handle fine. But the trap is, when people assume the split reflects who actually put the money in or who spends from it. Centrelink doesn't care about that. It cares about the legal ownership structure. Let's run the numbers on a real example. Meet Margaret and Ron. Both are homeowners, both receiving a part-age pension. They have a joint account with $120,000 in it. That's their household buffer, built up over 30 years of careful saving. Under the assets test, each of them is assessed on $60,000 from that account. For a couple combined, the assets test lower threshold is currently around $470,000 for homeowners, so that portion alone might not cut their pension. But Ron also has $180,000 in a term deposit in his own name, and Margaret has $90,000 in a managed fund. When you add it all up, including that joint account split, their combined assessable assets climb well above the threshold. Their fortnightly pension gets reduced, and when they came to me, they genuinely hadn't realised the joint account was contributing to that figure at all. Now here's the myth worth busting directly. Some people believe that if they can show Centrelink that one person contributed most of the money, the split changes. In most cases, it doesn't. Centrelink's default is 50-50, and shifting that requires formal documentation and a clear case. It's not impossible, but it's not automatic either. So here's your fix, and it's a three-part check. First, list every joint account you hold, whether that's with a partner, a child, or anyone else. Second, note the current balance and confirm what figure you've actually reported to Centrelink. Third, if the balance has moved significantly since your last update, check your reporting obligations and get that updated quickly. And just to be clear, I'm giving you general information here, not personal financial advice. Your situation is your own, and it's always worth talking to Centrelink directly or sitting down with a licensed financial advisor before making any decisions. Now, if joint accounts catch people off guard, offset accounts catch them completely flat-footed. And I say that because this one hides in plain sight. Here's how it usually goes. Someone has a mortgage-linked offset account, they're focused on the home loan balance, and they think to themselves, well, that money is working against my debt. It's not really sitting there as savings. Except Centrelink doesn't see it that way. The cash in your offset account is still cash. It's still accessible. It still belongs to you. And that means it still counts as a financial asset under the assets test. Here's the part most people miss. The offset account reduces the interest charged on your mortgage. Yes, but it doesn't reduce the value of the account itself. The presentation of it, bundled into your home loan statements, sitting alongside your debt figures, makes it feel like it's absorbed into the loan. It isn't. The balance is yours. Centrelink counts it as yours. And if you've never separated it out in your mind, or on your Centrelink records, that's a gap worth closing. Let me give you a simple example. Say you've got $85,000 sitting in an offset account linked to your mortgage. You're focused on the fact that it's saving you interest on the loan. That's a genuine benefit. No argument there. But from Centrelink's perspective, that $85,000 is a financial asset, sitting alongside whatever else you hold, term deposits, super, shares, the lot. If you're a homeowner couple and your combined assessable assets are already close to the lower threshold of around $470,000, that $85,000 can push you into a reduced pension or out of the pension entirely, not because your situation changed, but because it was never properly reported. Now here's the action framework I want to leave you with. 3 numbers that matter for anyone with an offset or mortgage-linked account. Number 1. The current balance sitting in the offset account right now, not the loan balance. The offset account balance, write it down. Number 2. The total of all your other financial assets, everything you've already got on your Centrelink records. Add the offset balance to that figure and see where it lands relative to the assets test thresholds. Number 3. The date you last updated Centrelink on this account. If that number has moved by more than a small amount and you haven't reported it, you've got a reporting obligation to check on. That's it. 3 numbers. Balance, total picture, last update date. Simple. But most people have never sat down and done it for this specific account type. As always, what I'm sharing here is general information only. Your circumstances are unique, And before you make any changes or decisions, please check in with Centrelink directly or get advice from a licensed financial advisor who knows your full picture. If this is landing for you and you want more of this kind of plain language breakdown, hit subscribe and drop a comment below. I read every one of them. And if offset accounts catch people flat-footed, this fourth one catches them with the best of intentions. Because the people who fall into this trap aren't being careless. They're being organised. They've got a plan. And that plan is exactly what gets them into trouble. Here's the scenario. You sold an investment property 6 months ago. Or you received an inheritance. Or you moved money out of super and you're figuring out what to do with it next. So you parked it in a term deposit or left it sitting in a high-interest holding account. Just temporarily. Just until you work out the next step. You've already decided in your head what that money is for. Maybe it's going towards the grandkids' education. Maybe it's earmarked for a renovation. Maybe you're waiting for the right financial product to open up. The intention is clear. The plan exists. But here's what Centrelink sees. Cash, accessible, countable, today. The mindset trap is this. People assume that because money has a future purpose, it doesn't count right now. That's one of the most common myths I come across, and it's worth saying plainly. Centrelink assesses what you hold at the time of assessment, not what you plan to do with it, not where it's headed, not the intention behind it. The balance sitting in that term, deposit on the day, Centrelink reviews your record, is the number they use. Let me make that real. Say you've got $120,000 in a 12-month term deposit, parked there while you sort out your next move. You're a homeowner. Your other financial assets sit around $350,000. Combined, that's $470,000, right at the lower threshold for a couple. That $120,000 pushes your total assessed assets to $470,000 and beyond, and depending on the timing, you could be looking at a reduced fortnightly pension or no pension at all, not because your long-term plan changed, but because the temporary holding position is being counted in full right now. The fix is straightforward, and it comes down to 3 things. First, report it accurately. If you've received a lump sum and parked it temporarily, Centrelink needs to know. Staying quiet isn't protection, it's risk. Second, if you genuinely know where that money is going and when, document that timeline and explore whether the destination changes its accessible status. Money going into super, for example, or into a primary residence renovation, may be treated differently once it moves. That's a conversation worth having with a licensed financial advisor who knows your full picture. Third, don't let temporary become permanent by accident. Review the holding account every 90 days. If the plan hasn't moved forward, the money is still sitting there being counted, and your pension position is being affected the whole time. And that's the thread that runs through all 4 of these accounts. The everyday account, the joint account, the offset, the temporary holding. None of them feel like pension traps when you're managing them day to day. But each one has a way of sitting quietly on the wrong side of the assets test while your pension takes the hit. This is general information only. Everyone's situation is different, and I genuinely mean it when I say, please check your specific circumstances with Centrelink or a licensed financial advisor before making any changes. If this series has helped you see your accounts differently, I'd love to know which one surprised you most. Drop it in the comments below. And if you want more of this kind of straightforward breakdown every week, hit subscribe. It genuinely helps, and I'll see you in the next one.